Buying and holding this high income ETF forever? Well, dumping QQQI and JEPQ? Hey everyone, it's Doug, the retirement guy with all your monthly ETFs. We're going to cover something here, high income ETFs. And this is the statement I got from one of our Patreon supporters. He sent it to me and he said, I have to disagree with you, which is 100% accepted. I'm not always saying I'm the smartest guy in the room, but he comes straight out and said, I am buying and holding this high income ETF forever. I'm never getting rid of it. I'm dumping QQQI and JEPQ because I found a better fund. He told me the fund, and I'm going to cover it with you today and share with you a conversation I had with one of our Patreon supporters. Let's get into today's video. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who has been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. I have covered some of the best ETFs for dividend growth and minimizing the risk on this channel. But today I'm going to address the trend that is possibly being ignored. Its explosive rise in the high income ETFs, and specifically, we're going to look at a fund that breaks the standard lazy playbook to deliver some serious edge. Now, this was a conversation I had, like I said, with a Patreon supporter, that he is trying to maximize his income and growth. And he thinks this is the new era of covered call ETFs that are coming out. So when we sat down with it, I kind of put this picture together to kind of give me an idea for more of our conversation, is he's constantly thinking about which is the best ETFs to be involved into. Where should he be putting his money? He's looking for some growth. He's looking for income. He's been a good supporter saying, I'm looking at total returns, man. I'm looking at total returns like you've taught me. And I agree with him 100%. So we started talking even more. And it came into this, the high income playbook. How covered call ETFs generate premium income while providing some downside protection. You know, that what they really do, most covered call ETFs follow a similar script. They sell options on their incidentals and to generate that premium. The yields of about 10% or more, providing steady cash flow. But importantly, the premium acts as that natural cushion to smooth out volatility and offset price drops. The income generated from those selling of those call options helps to generate that 10% yield, that about a 15% downside protection, pays monthly, and the average right now is about 0.56 expense ratios. So I started asking it. I said, what's the issue with all this? I mean, this is the high income business. This is the covered call strategies for income. What is wrong with it? And he basically come back to me and said, it's a lazy index problem. The most popular ETFs just track the S&P 500 or the NASDAQ 100. Their holders are nearly identical, while some are trying to be different by handling hand-picked stocks, but many are just lazy. The selection process is really just a lack of real strategy. And I can't disagree with him on his comment, but I did tell him point blank, I said, I think you're over-analyzing and overthinking the whole process. And he continued on with it and said, like standard ETFs. He says they're just the passive index tracking, they're identical holdings. He goes, there's no real strategies, and it's a high tech concentration. 55% of most of the of the funds are in the technology sector. He goes, so if one drops, they're all going to drop. He says, I want something that's a little bit different, playing in a different game. He says, the standouts. He says, I want to see an actively managed fund. I want to see intentional pairing of funds. I want to see quality focus. I want to see a balanced exposure. He says, I got mine at 46% tech, and I got other areas that are defensive sectors. He goes, I want that superior risk adjustment returns. And I turned to him and I said, okay, great. You have all this. You're telling me all this. What fund are you actually working with? And he dropped me the bomb and said, QDVO, Amplified's Growth and Income ETF. And I'm like, I've covered this on the channel numerous times. And he says, yes, but you don't go deep enough into it. You don't share enough to it. And as QDVO is a great product. I'm very pleased with it, and we're going to cover it here. Amplified's done very well with this portfolio. When we take a look at what they've actually done, I said, this thing came out August 22nd of 2024. So, realistically, we're maybe a year and a half, give it a little plus or minus there, into it. They have $715 million in assets. Their expense ratio of 0.56 is right in the middle of the game. They have over 23 million shares outstanding, but they've paid $3.05 in distributions over the past 12 months. A dividend of 9.93%. So I'm like, okay, decent yield. But I want to look at, like I've always told him, we want to look at total returns. He said, I agree. I said, and this thing's bouncing at that 30-week high of $30.97, and the day range when we did this is $30.65 to $30.92. I said, so we're at the top end of the portfolio right now. So where are we at? He says, well, the investment strategy that they're using is they do a stock selection. Okay, they are doing call writing, but they're using a tactical approach to it. And the risk level is actually moderate. It's not very, we're kind of in the middle of the road here. So QDVO focuses on high quality stocks with strong earning growths and free cash flow generation. The fund uses a selective cover call strategy to generate income while maintaining growth potential. So like I said, I'm very pleased with QDVO, but the thing that threw me is when he said I'm dumping my QQQI and I'm dumping my JEPQs. He goes, and buying this and never ever changing, and I'm like, you got blinders on. You need to be open-minded to what is going on. When we started looking at this, and I told him, I said, QDVO has been on a massive growth. The assets under management, from when this thing started, and realistically where it's at today, it's just a projection line just straight ahead. It's up, like I said, that's $713 million of net assets. If it continues on the projected mark, I said this is going to be $1 billion fund in 9 months. And so the assets under management have, predictably have doubled, and it's a better liquidity and a lower transaction cost. So he was like sitting there saying, win-win, this is why I'm doing what I'm doing, and I'm giving him credit. But QDVO has definitely been on the run with the assets under management. Now, a lot of people will ask, why does that even matter? Well, it really does matter when you get into liquidity, that they do have the volume to handle some rougher times or some issues where they're going to run into, that the distributions may come down a little bit. But they're here for the long haul. They use a 2-pillar system, earnings and cash flow. QDVO focuses on 2 fundamental traits that matter most for long-term endurance. when they are looking for funds, when they are looking for companies to invest into and to do the stocks and so on, they're looking at the earnings growth. It's a signal that the company's ability to scale. Earnings growth signals a company's ability to scale and generate substantial profits over time. So when I looked at their portfolio, they're looking at a 12% growth year over year. They're looking at about $2.4 billion in revenue. These guys are really looking for margin. So they're doing some heavy research because they are, actively managed. They're also looking at free cash flow, which provides operational efficiencies. Free cash flow, that's going to mean increase in distributions. And that's going to mean that their capital effectiveness is helping with their capital reserves. And you're seeing this at about a 22% improvement year over year on the different funds that they pick up and bring in. So I told him, I said, we got to look at total returns. And he was like, yes, let's go head to head. So QDVO over the standard QQQQ or the VOO, which is the S&P 500, you can see that the indexes, they are definitely kicking the index's tails. 11.36% versus 6.92 or 5.92 in the S&P 500. So they're definitely doing more than the actual indexes across the board. So I got to give them credit. He is right. They are beating the indexes with what they're doing in the marketplace. And where's the difference? So I really started doing some analysis, breaking this down and looking at each one of these. How are these things different from QQQQ? Because it's really what the comparison is. QDVO and QQQ are two really in the same boat. They're in the same category. And I started looking at this, and you can, I'll break it down here shortly. They're in technologies, they're in communications, they're in the healthcare, they're in the financials. They're doing a lot of things that QQQ does. But how are they beating them? We're going to look at the portfolio construction of QDVO versus the index QQQ. QDVO is actually lighter on tech by about 9 percentage points and heavier in defensive sectors, creating more of a balanced portfolio. Now remember, we're dealing with indexes here. So when we talk about tech's exposure, now QQQ is definitely, the NASDAQ 100 is dialed heavily into that tech side. I'll give you that. 55% to now 46% of QDVO. We look at the defensive sectors. There's about a 13% difference in their defensive. This is why I say it's more of a balanced portfolio across the board. But the next one, actively managed. This is you're paying somebody, someone is involved into doing this to make sure that QDVO gets the right funds into the right spot, while QQQ, an index, is not going to have that management. They have it set up how they're going to do what they do. But here's the big kicker, I told him. I says, your dividend yield. QQQ is not set up for dividends. Most of that's going to come from just the stocks that are in part of it that do pay distributions. While this one here is giving you more dividend yield. So I'm going to tell you there's going to be a difference between growth and income between these two funds because they are apples and oranges. The biggest one I started doing a comparison with is this, and he did bring it up himself, was a comparative of NVIDIA. He says QDVO has 12% into NVIDIA. Now this is a tech stock. He says, so my 46%, 48% into tech, we're cherry picking. We're cherry picking the which techs we're going to be into. So his NVIDIA is at 12%, while QQQ is at 9.1. And when you look at the other funds, JEPQ, QQQI, 9.8 and 7.2, he says you can see NVIDIA is the better strong play. Again, his opinion. into 12, so I'm seeing that into 12%. So it makes more sense to be into this than QQQI or JEPQ when they're just following the sector. So the tactical versus index call writing. This is another thing that he brought into play. QDVO uses a technical strategy. It chooses specific stocks to write calls against and then letting the others run uncapped. This is where they're trying to get more growth by playing and I call it manipulating, but basically using a strategy that they're not always writing cover calls on all of their products. So the strategy comparison. Most funds sell calls on the entire index, which caps the growth of every stock uniformly. Caps the growth of all the stocks, lower premium generation, limits the upside potential, while QDVO chooses specific stocks to write calls against, letting others run uncapped. Selective call writing, higher premium generation, and superior growth potential. Okay, so using the strategy toggle, when we look at the two again, the indexes, the entire indexes put out there, the growth caps of all stocks, the premiums are lower, the upside's limited. QDVO gives you a selective call writing, specifically only for growth cap, higher premiums, and enhance. So on books and paper, it looks like it is definitely a better selection of using this type of option and this strategy. And I agreed with him. I like the strategy across the board. Do the numbers tell the same story? And I started showing him, I says, first off, let's look at price change. This is kind of going to be your growth side of it. QDVO versus QQQI and JEPQ. I said, look at the numbers. I said, yes, you're beating JPQ, but you're not crushing QQQI over the past 30 days. And I really wanted to show him this window because April had the huge drop off. Okay, we had a huge drop off in April, and the NASDAQ has gone gangbusters over the past 30 days. So I'm not trying to give them long past histories of what's going on. I'm trying to take a snapshot of today's conversation and what's going on. And you can see we're only about it's not even 1.1. It's about 1% difference between QQQI and QDVO for price change. When we get into total returns, I told them QQQI is beating QDVO. Now, again, I'm not going to argue this and say, oh, we're crushing you, but we're ahead of you. We're 0.4 percentage points ahead. So for you to state out that you're going to drop them all and sell them off and get into QDVO, your total returns are matching each other. So I don't understand what the argument was that QQQI is doing such a bad thing. Now, JEPQ, I can understand saying I'm going to get rid of that because I've doubled my total returns or I've doubled my price changes. I can buy that. But to throw QQQI into it, and I'm not promoting saying, oh my God, you can't touch a NEOS product or you can't touch QQQI. That's, you can do whatever you want with your money. I'm just saying you got to make some true hardcore decisions, but you haven't proven to me where anything's different. JPQ, definitely, I can buy into what you're talking about. So when I laid it all out to him and put in like I'm doing here, I says, let's look at this. Let's look at yield. Now, again, I tell you, we're not chasing yield. I don't want to chase yield because we're going to chase total returns. And QDVO, over the past 12 months is up. And I'm going to start the total return at 30.78% with a yield of 9.93% and the growth at 17.51. We compare that to QQQI giving you 13.50% yield, a 12.94% in growth, for a total return of 30.20%. Now JEPQ giving you yield of 10.26%, growth of 15.43, but a total return of 28.72. And when you talk about, and I just have it on there, QQQI giving you that yield of 0.39, but you got growth of 39.86%, winning the whole market at 40.53. So if the indicator and the index is, if you're within that, like here, 10 points difference of total returns of the index, but you're getting income for that 10%, I'm all into it. If you're looking for, what are you looking for? Growth? Then of course buy the index. If you're looking for income, you're going to play in this other category. So my point of what I've shown them here, and I show you straight out, if you're trying to replace JEPQ, I'm okay with this. I'm okay with what you're doing. You're 2 percentage points up. But the way he come across that he is done forever, he's locked in, he's buying QDVO forever, I'm just thinking you're putting blinders on because it's not as great or as big as the other players. It's a good fund. Again, I'm not against anybody. I think QDVO has its place in portfolios. I will tell people it may be a better play than JEPQ, because of the, what they do with the ELN, the notes, and you're more playing in a market that you have someone watching it, and you can show that their system definitely is giving them more growth. But where are you at in life? Do you need growth or do you need income? I personally am in retirement. I want my income, and I look at the total returns. There's not a big enough difference to take away from my income to just get growth. But that's where he was at. He's thinking he wants more and more growth. And then once I put him on the platform, he looked and said, wow, I'm losing almost 3 percentage points. Almost 3.5, to be honest with you, in income to get and gain growth. And I'll tell you, he told me straight out, I don't really need growth. So he got rethinking his whole idea about, I'm out, selling all this out and saying, you're right. Now, this is the next one I started talking to him about. And I wanted to share this one for sure because we started digging deeper into this. It's the tax efficiency. Now, QDVO distributions are typically reported to shareholders on a form called a 1099 DIV. Very common, very usable piece. And their funds normally fall into 3 different categories. 1, ordinary income. And the income is derived from underlying stock holdings in the portfolio. If the stock holds for the required period, they can classify their dividends as qualified dividends, which would lower your taxes and put them into long-term capital gains. You have no control over that. The capital gains realized from gains from the selling stocks for the funds or option strategies, because QDVO uses a covered call strategy, writing call options, a portion of the income may be treated as short-term capital gains or ordinary income rates. Now, they also use a return of capital. Now, these are non-dividend distributions. They are generally not taxed in the year that they're received. Okay. Instead, ROC reduces the cost basis of the ETF shares. The last report that they had was 90% of the distributions were classified as return of capital. So he was excited about this, and he says, see, it works just like everyone else. But I always got to say this. You got to verify the final tax year tax report before just assuming the tax status. Because the 19A1 notice may not reflect the actual distribution characteristics. I said, this is great. 90% of your fund that you're telling me has been a return of capital. I did some bigger research into this, and I had to tell him, I said, I can't tell you a lie. I got to show you the proof. And to be honest with you, and look at the tax efficient reality of the fund, the truth about ROC and the big differences. QDVO reported 90% ROC. The final report that they actually put out to investors, and I've got to give them a shout out because they actually had this on their site. Now, a lot of people don't do this. They bury it and they forget about it, and so it doesn't get reported. But they actually reported that only 11% of their distributions were actually ROC. That left 89% of the distributions open target for what tax they're going to fall into. So this is the one thing, when you see people reporting this, and they do it all the time, they report this week it's 100%, this week it's 90%, it's all these numbers, is because they don't give you the final number until that final report goes out at that 1099. Only realizing capital gains counts. So all the fees, the expenses are included, the reflection of actual performance. Reality is really different from what they're going to tell you. This looks great in marketing. So don't be misled by inflated numbers. Your final report is what really matters here. And unfortunately for him, I told him, I says, a lot of your stuff's being taxed at regular income. So I told him straight out, I said, QQI just wins the tax war. They're the tax efficiency ETF. That's why I don't want you to just sell off and walk away and be done. I want you to take a serious look at this. If you're putting this into a Roth IRA, okay, we're done talking. I mean, it doesn't really much matter. But if we're sitting there saying, hey, I'm putting this in a brokerage fund, this matters big time. This could be huge. Now, QQQI uses that 1256 contracts, which is really the 60-40 capital gains. We've covered this before. If you don't know, leave a comment. I'd be more than happy to explain it to you. But they use the 60-40 for capital gain treatment. It lowers your taxable income. It's the most tax efficient structure. And the funny thing is, we talked about this. They also use an ROC system. Okay, so they do use some ROC in their mix to give you the best total across the board superior tax efficiency, and more of your return stays in your pocket. Now, QDVO relies heavily on ROC, and you can see that they didn't have the proper change this year, so it was only 11%. So that teeter-totter, that tipsing thing, the advantage definitely is QQQI. So my game plan to him is, am I selling QQQI? I said no. I am not going to do that. It's got a strong income with those option premiums. It's got a nice diversification of the NASDAQ 100 exposure. It uses the favorable tax treatment at 60-40 and the ROC. It's got a proven track record and consistency, and the core holdings stay in my portfolio. Now, am I buying QDVO as an add-on to a Roth fund? Maybe. It depends on where I'm at. Where do I need more mix? Do I like the extra growth? Do I need some help in that category? The high income with a strong total return potential definitely puts it in that class. The high exposure to growth stocks like NVIDIA, I'm excited about what they did with QDVO. This is a great fit for a tax advantage accounts like Roth. Okay, it adds diversification to my income strategy, not just replacing. I'm looking to enhance. This is why I said, hey, if you want to do a whole nother conversation about I want to get rid of JEPQ, well, now we're going to talk a little bit here, because JEPQ has to be in the Roth because they're using ROC across the board. They're giving you stuff as ordinary income. So the strategy, I'm keeping QQQI. I told him keep it straight out. And after we got done with the conversation, he said, I hate to say it, but you're right. I'm gonna have to follow through with your head. Considering QDVO as a Roth add-on, I'm 100% supportive of it. And replacing it from your JEPQ, it's got some merit to it as well. So I'd love to hear your opinion after seeing what your conversation was. Did I lead them the wrong way? Did we go the right way? I love your input. I love to hear it from my over 13,000 viewers. Tell me if I'm right, wrong, agree, disagree. Leave a comment down below. Don't be afraid to hit that like button. Like I said, we talk to people on our Patreon group. I'll leave a link down below in the description if you want to join Patreon. It's free. You can see the conversations going on. But we're always here to help support you.
Thank you for watching. Press the